Welcome to Talk Tickers. Today, we're digging into Inotiv's wild Q4 earnings call. The stock initially popped over 8% after hours, which looked great, but then it completely cratered over the next 2 days. So, what happened? We're going to get into it. All right, here's how we're going to break this down. We'll start with the headline numbers, then we'll peek behind the curtain to see what's really going on. We'll cover management's big plan to turn things around, look at the market's crazy reaction, and then we'll wrap it all up with our take on what to watch for next. You know, Inotiv's Q4 results are a perfect example of a good news, bad news story. It's really a tale of a company fighting its way back to health, but it's got this massive weight chained to its ankle. And this right here is the central conflict you have to understand. On one side, the income statement, the P&L, is looking so much better. I mean, they cut their operating loss almost in half and more than doubled their adjusted EBITDA. That is some serious progress. But then you look at the other side, the balance sheet, and it is under some major strain. And look, if you just glance at these numbers, you think things are great. Revenue came in right where everyone expected. The loss per share was a huge improvement from last year, and that adjusted EBITDA number up 118%. That's the kind of firepower investors get really excited about in a turnaround story. But as soon as you dig just one level deeper, you see this massive split in the business. It's like they're running two totally different companies under one roof. And this chart just says it all, doesn't it? The Discovery and Safety Assessment business, that's DSA. It's on fire, growing over 15%. This is their high-value stuff. But then you have the Research Models and Services segment, RMS, which is basically dead flat. So you've got this powerful growth engine on one side and this heavy anchor on the other. And the good news is that momentum in the DSA business looks like it's here to stay. They posted a super healthy book-to-bill ratio of 1.08. Now, if you're not familiar with that term, it just means they're signing up more new business than they're billing for right now. That's a fantastic sign for future growth. And you better believe management was hammering this point home on the call. Net awards in DSA skyrocketed, up 61% from last year. Their backlog, which is basically their pipeline of future revenue, is sitting pretty at 138 million. And maybe most important, they're turning that backlog into actual cash faster than they have in 3 years. This engine is firing on all cylinders. Okay, so knowing all that, management's playbook is actually pretty simple. 1, keep that DSA engine roaring. 2, go in and fix the broken RMS business. And 3, a big one, figure out how to deal with this mountain of debt. And they are not messing around with the RMS turnaround. This isn't just a little nip and tuck. Over the last 3 years, they've shut down about 60% of their RMS facilities. That is a massive consolidation effort, all designed to slash their costs and get that side of the business healthy again. So all this progress on the operations side looks really promising, right? The good business is growing and they're fixing the not so good business. So what's the big problem? What's holding the stock back? Well, here it is. $402 million. That's how much debt is sitting on their balance sheet. For a company this size, that is just an enormous burden. And that debt has very real consequences. Their interest expense for the quarter was almost $16 million, up 27% from last year. Now get this, that one expense is more than their entire adjusted EBITDA for the quarter. It completely erased all that hard work they did on the operational side and dragged the company into a net loss. Now, to their credit, management knows this is a huge problem. The CEO, Bob Leisure, was very direct on the call. He said they've hired advisors and are actively trying to refinance this debt. This is job number 1, 2, and 3 right now, because the operational turnaround won't matter if they can't fix the balance sheet. And, as if that massive debt wasn't enough, they're also juggling a few other issues. They're still cleaning up the mess from a ransomware attack, and they've got ongoing costs from a compliance agreement with the Department of Justice. It's just more cash and more focus being drained away when they can least afford it. So with all these moving parts, some good, some really bad, how did the market react? Well, the stock's price action in the 48 hours after the report tells you everything you need to know. At first, investors saw those headline numbers, the revenue, the EBITDA, and they got excited. The stock shot up about 8% in after-hours trading. But then, reality set in. Over the next couple of days, the stock not only gave back all those gains, but it fell even further, ending down almost 14% from that initial high. What you're seeing here is the market thinking out loud in real time. That first jump was pure excitement about the operational fix. But that excitement got completely squashed by the cold hard reality of the balance sheet risk. At the end of the day, that debt anchor is just too heavy for the growth engine to overcome by itself. So what's the big takeaway from all this? And what are we looking for in the next quarter? Here's our call on how this plays out. Look, our view is that Inotiv is a classic high-beta, high-risk turnaround play. We fully expect to see another strong quarter from their DSA business, but we also fully expect them to post another net loss because of that brutal interest expense. So here's how you have to think about the stock. It's basically a call option on a successful refinancing. If they cut a deal to fix their debt problem, the stock could really fly. If they can't, the risk is very, very real. Because of that binary outcome, we're rating it market perform. We see the progress, but the company's future is now almost completely tied to solving that balance sheet problem.
This is not financial advice.